Hello, everyone. Welcome to our part two of Chapter 9, Tax Credits. We're going to pick up where we left off, talking about the child tax credit. This is the most, probably the most common tax credit available to taxpayers, and so it's important that we understand the details about this. So this, remember, we learned way back in the early chapters the definition of a child and a dependent. Qualifying child was more restrictive than a dependent. Um, this is for taxpayers with children. Qualifying child have to fit the same criteria as back in chapter 2, but also is under 17. So qualifying child can be over that, but this is under age 17. So the year they turn 17, you're going to lose this credit. Child must be a U.S. citizen or resident, and this is in addition to being a qualified child, must be younger than the person claiming the credit, and I'm married. So this is even more restrictive than a qualifying child that we learned about. 2,000 each for each one, phased out over AGI limits, as we've come across on these credits. Many of them, almost all of them, are phased out in some way or another. And this one has the wonderful distinction of being both refundable and non-refundable. So the difference, of course, is whether it can create a refund, whether with no tax liability, if you can still benefit from it. Part of it, 1,700, is refundable. The other 300 would be non-refundable, meaning if you had no tax liability, you would not be able. The maximum you could use is 1,700 per child, and then just as a consolation prize, if you have other dependents, remember the definition of other dependent from way back in chapter 2, not the qualifying child, but the other much more broader definition. If they're dependent, there is a credit of $500 for them if they do not fit the qualifying child status or the under 17. So the child reaches 18, even 17 that year that they turn 17, then we just have this $500, okay, non-refundable credit for that qualifying dependent that don't fit the under age 17 definition of children. So that is always non-refundable. So that doesn't it also has that issue that it's non-refundable. You can't get it back as a refund. Where's the phase out start? Well, nice round numbers, making it easy to remember. Haven't been adjusted for inflation. One of these days that's probably going to change, but for now, 200,000 for everyone other than married filing jointly to get 400,000. So only two phase out range. And this is different than the other situations as far as how they phase out. Other ones we've run across, they phase out as a percentage of the amount over the threshold, and then they get 100% by another threshold. They're all gone. This is reduced by $50 for each $1,000, a fraction thereof, of AGI in excess of the above amounts. So this is done in little chunks. You lose a little bit, okay, as your income grows. So you take this, your AGI of 217, you subtract the 200,000, okay, you've got 17, right? 17,000. So $50 for each of those $1,000. 17 times 50, $50. Okay, is 850. That's how much you're going to be reducing your child tax credit. So it depends not only just on your AGI, but how many of your children the tax credit you have. So if you have 4 children and your original tax credit is 8,000, obviously it's going to take longer to get to zero than if you only had one child. So that's different than some of the other credits. Okay. Same thing for married filing joint, except you start at 400,000. Notice it's a fraction thereof. So even if it's a little p, if this was 2017, it's always rounded up. Okay, so 17,000 is treated the same as well, let's look at another example. Two qualifying children, ages 11 and 8, filed jointly. Their AGI is 112. They're not even close to the amount over the limit. Okay, so they get 4,000 total because their AGI is not even close. Okay, but let me see if we can't think of an example that would help us understand this fraction thereof. So nice round numbers like 217 would be 17 times 50. But if it was 2017 and $5, it would be 18, because that $5 would be one more $1,000 piece, or a fraction thereof. So the 2017 and $5 would be treated the same as $218,000 of AGI. Okay, so this is a oddball way to make it disappear or make it phase out. Probably the most complicated of the various ways we do it in the tax law. Okay. First one, of course, is true because they're over 17. And then 3 is qualifying. Is this person a qualifying relative, unemployed widower, U.S. citizen, unrelated, but he lived with them the entire year? Remember, that was still fits under qualifying relative. That's a long time ago. We talked about that, but that does fit back in the qualifying relative. Lives with them. They provide. He doesn't have any income. Doesn't have income over the threshold. Therefore, they can claim a credit for him as a dependent because he lived and they provided all of his expenses, even though there's no relationship. All right, next credit, retirement savings contribution credit. This is a really good deal for those in lower income brackets who make contributions to one of these qualified retirement plans. Now remember, we really haven't gotten into it yet. Chapter 11, we'll go into detail about these, but typically what happens with your contribution to these type of retirement plans is they provide you with a tax deduction, meaning you don't include, depending on if it's an employer plan or not an employer plan. For instance, I put money into our 403B, which is because we're a nonprofit here at HAC. That money does not even get counted as my income. When I get my W-2, it's already subtracted out. Okay, so I've already gotten a tax benefit from that. But this credit I would also receive if my income qualified. Okay, and I would get a second tax benefit. This is what some people would refer to as double dipping. There are very, very, very few times in the tax law that that's the case. Usually, if you find it that you're thinking that something is being double dipped, it's because you've misinterpreted the tax law. But this is actually how this is to be interpreted. Now, of course, the maximum is only $2,000, and as you'll see, the limits where this starts to disappear, the phase-out limits are very low or fairly low, and they what we call happen in very abrupt changes. Okay, so for instance, your income, if you're a joint filer, up to $46,000, okay, you can get a 50% of the amount you put into your retirement plan. Now, this is on top of the deduction you already got because you put it in through your employer, perhaps. It wasn't even on your W-2. You get another credit, a benefit credit. And again, this is a non-refundable credit, but it could reduce how much tax liability you have, but not below zero. 50% of the amount you put up to 2,000. Remember, that's maximum 2,000. So if you put in 3,000, the maximum you can count is 2,000. But you would get a credit for 50% of that against your tax liability. But as soon as your tax liability goes over 46,000, it goes 46,005. Now your benefit, your credit is only 20% of that 2,000. Remember, it's still limited to 2,000. It's now only 20%. And then as soon as you go over 50,000, it drops again to 10%. And at 76.5 AGI, it's 0. So it's gone from 46 to 76. It's gone from 50% credit of the amount you put in to 0. And you see the other thresholds for head of household, which is lower, and anybody single, married, filings separately uses the one on the right. Okay, so there's a very abrupt changes. It doesn't happen gradually, but it's very abrupt, and that's the thing to remember about the retirement savings contribution credit. But it is a double dip. It's two tax benefits: the credit and the fact that you didn't include the money you put into your retirement originally in your income. So 52,000, you just go to the table, you find where they fit. They're married filing jointly, $1,500. Okay, they're here between the 50 and 76, so their credit is 10% of the $1,500 they put in, or $150. Okay, 2,200, it can't count more than 2,000, right? So it's only 2,000, but his income, as we go back to the table, okay, is low enough as he head of household. You see that head of household, he's under 34, gets a full 50% of the credit, or $1,000. 50% of what he put in after you reduce it to 2,000. All right, the next one is adoption credit. This is a large credit, but it usually means because the cost of adoption is so prohibitively expensive in many cases. First of all, you've got to have a certain amount of income or you can't afford it. But if you paid $16,810, seems like a lot of money, but easily in adoption situations you'll go through that to be able to offset that. So you spent that $16,810 and that reduces your tax liability because your AGI is probably on the higher side. Okay, you probably have plenty of tax liability to use this credit against, but this is non-refundable. So if you don't have the tax liability, it's not going to get you a refund. And of course, like others, and it's 100% of the qualified adoption expenses paid in the year of that it is finalized. Now, what happens is some of these adoptions carry on for years, meaning that you spend money over multiple years before the adoption is final. That was considered, and they set this up, and they basically said, all right, yeah, we'll allow you to use money you spent over multiple years, but not until the year that the adoption actually happens, because until it actually happens, you don't know that there actually is an adoption. Okay, so you've spent money in 2023 and 2024, and the adoption isn't final until 2025. You can count all of those costs if you need that much to get to the 16,810, but you can't count more than the 16,810 anyway. Okay, even no matter how many years it takes, and it phases out at 252, 150 starts and is gone by 292, 150. Of course, that's adjusted for inflation, so each year that's going to change. There's your formula that you might use if you have your income between 252 and 292. You're going to subtract the modified adjusted gross income, and then compare it to the $40,000 phase out range. So if you're halfway between, you're going to lose half your credit. If you're really close to the 292, you're going to lose most of your credit. If you're really close to the 252, you're not going to lose very much. Okay. So example, incurred the following expenses in adoption of their infant daughter, which was finalized in 2023. Okay. That really should say 2024, because the way the problem works out here, which was finalized in 2023, paid that 10,800, 2024 3950. Typically, the year that's finalized is the last year you're going to pay payments. If their modified adjusted gross income is 120, they're well below the phase out, but they can count the expenses for both years. Okay, in 2024, they're under the limit for the total, so their credit is for all of the expenses that would happen. There's 14,750. Qualified adoption expenses adoption of their son, finalized and all expenses occurred in the current year. So it all happened in 1 year. That would be very unusual, but let's say it did. But notice they're over 18,000 over the limit. So they first of all stop at maximum of 16,810, and then they apply the phase out formula we learned about earlier. They are roughly halfway in between, and so they lose half of the credit. So instead of being 16,810, which is the maximum, it's only 8678, as you see there. All right, earned income credit. This is an interesting credit that is designed to help those that are earning income, but not enough to pay all their expenses per se. So it's kind of a it's actually set up as a negative income tax. It's refundable. It's based on your filing status, your qualifying children, 0, 1, 2, 3. It doesn't keep going up as you get higher than that, though. And the earned income amount. So what it does is, as you earn income, as your income is higher, but it's still very, very low, it is low. And it actually goes up as your income increases. Then it hits an area of income where it's the maximum, and it, for several $1,000s of income, it's the same. And then it starts coming down again if your income is getting too high. So it is at its maximum at what they might consider the middle range of that low income area. This is earned income is only wages, salaries, tips. In fact, you can be disqualified by having too much other types of income. In fact, other income that we consider mostly like unearned, like investments. If you have more than 11,600 of income from those, that's a lot. It would be ineligible, because basically you have enough assets that are earning that interest that you shouldn't need this help, okay, to pay your bills. Now, the formula to do this is given in your textbook, is quite complicated. And there's a phase out. There's an area that you can use this formula, and the type of way the formula works is given in this second answer. I typically recommend that the best way to calculate the earned income credit is to use the earned income credit tables at the end of your chapter 9. And it should get roughly the same. It might be a little different by a couple dollars. Okay, in this case, it's exactly the same. Using the formula and looking it up in the end of the chapter. And what you have to do if you look it up is you have to look up two things. You have to use your earned income and look it on the EIC table. And then you have to use your AGI. And the only difference between your earned income and the AGI would be things that are unearned, like interest or stuff like that. Typically, that's a very small difference, but you need to do both because your credit, your earned income credit, is the lower of the two. So you look it up twice. You use the lower of the two. And that is almost always a more reliable way than applying the formula. But you see the number here, you're certainly never going to remember it. You'd always have to look these up. But if you look it up in the table twice, you can feel pretty confident that you've got the right answer. This feels a little more scary, making sure you have the right thing, but you can do it either way. Tiffany's head of a household taxpayer. Make sure you're using, whether you're looking up on the credit or your formula, you got to make sure you know the status. She had earned income of $16,000. Okay, if her tax liability is $800 for the year, what is her amount of a refund or tax owed? Okay, so again, you could look it up on the table twice. Her earned income and her AGI would be the same, so it wouldn't need to look it up necessarily twice because they give us no more information about any other income. So $69.60 with 2 children is, I think, the maximum. Let's go back to our maximums. Nope. The maximum's on the next page. Next slide. Nope. Where's our... Oh, I think it... Okay. That's close to the maximum. And then, because it's refundable, you offset the tax liability of $800, and then you would get $6,160 back. All right? So that's how it works once you know the amount of it in applying it to the tax return. And the last credit we want to talk about is a premium tax credit. This is a credit to offset the amount that you have to pay for health insurance. It only applies if you buy your health insurance through what's called the marketplace. Each state has identified, has set up a marketplace to buy, help taxpayers or, well, anybody, whether they're a taxpayer or not, buy health insurance. And the credit is for everybody. Originally, it was those who had the lower income, but it actually can apply to anyone. And what happens is you figure out how much you paid for insurance or how much you would have paid for insurance if you bought the plan that they would typically recommend, and compare that to how much you should have paid based on your income. So percentage of your income that's kind of on a sliding scale as your income goes higher, and you subtract, and then you got the difference, and that's kind of what the government is helping you cover for your insurance by providing this credit. All right, so that's what's kind of described here. You look at the insurance premium paid or the second lowest silver plan, which basically, if you signed up for a very, very good plan, I mean, it pays lots of different things and covers a lot of things, you only get a credit for if you had bought this kind of mid-range silver, because there's silver, bronze, and gold plans, type of scenario for your age and situation. So you can't use what you actually bought if it's higher than this amount. If it was lower, if you got a better plan, then you use that one. But the silver plan is typically, most of the time when I see these, the silver plan is a little bit lower. And then you compare that to what you should have paid based on your income level, and it has some adjustments for where you live, depending if you're in a really high cost state. And then that credit is provided. There used to be a credit for if you did it, and there was a penalty if you didn't buy insurance. Now the penalty has gone away. Okay, the credit stays in place, and in fact, they made it more available, because even if your income is higher than 400% of the poverty guidelines, you still can have It's not going to be much of a credit, and it's still going to depend on those other calculations, but it's still available. It's not like prohibited like it was in past years.